Welcome to the Deep Dive. We're digging into the Canadian real estate market for Q3 2025 today.
And the big story, really the headline we're seeing everywhere, is profound divergence.
Yeah, exactly. That idea of one single, uniform Canadian market, it feels, well, completely gone now.
That's really the critical takeaway for you, the listener. And remember, we're seeing this play out against a pretty challenging backdrop.
Right, we've got a decelerated national economy. Those U.S. tariffs are definitely putting a damper on some export sectors.
But there's also some relief. The Bank of Canada did step in, dropping the benchmark rate down to 2.50%, trying to stimulate things a bit.
So it's this mix, isn't it? Monetary easing, but real economic uncertainty.
Which is forcing what you call that flight to quality.
Yeah. Success now isn't about looking at the whole country on a map. It's about zooming in, right down to the specific asset, the specific block.
And that idea immediately pops up this paradox in the multifamily sector.
Okay, how so?
Well, nationally, things like rent growth, vacancy rates, the operational fundamentals, they're actually softening a bit, moderating.
And that's tied to the policy shift on non-permanent residents, the NPRs, right? Fewer temporary folks coming in.
Exactly. It's creating a kind of structural loosening in the rental market, at least in the near term.
Okay, so vacancy is ticking up slightly, but investors haven't bailed. Why not?
They're looking long term, way past this cycle. Investor conviction is, still incredibly high.
Really?
Yeah. Multifamily still gets the lowest cap rates.
Yeah.
We're talking investors accepting razor-thin initial returns, maybe 100, even 200 basis points below other asset classes.
Because they fundamentally believe in the housing shortage story.
Precisely. They see this short-term dip in demand from fewer NPRs, but they're convinced the long-term structural need for housing hasn't gone away. That gain is kind of baked in, they think.
And this is where the divergence really shows up, geographically. Look at the GTA, Greater Toronto. It's showing amazing stability.
Lowest tenant turnover rate among the major cities, just 15.5%. Even with new lease growth moderating to 1.2%, that base is solid. Very defensive demand.
Okay, contrast that stability now with, say, Calgary.
Yeah, Calgary's facing a much tougher near-term picture, a real supply-demand imbalance right now.
How bad?
Highest vacancy rate among the big cities, 5.8%. And crucially, it was the only major market with negative rent growth on new leases, down 3.0%.
Wow, negative 3%. That's volatility right there.
Exactly. That's the kind of divergence you need to track.
Okay, so if multifamily is a paradox, what about commercial real estate? Sounds like it's just fractured.
That's a good word for it, especially the office sector. It's really a tale of two tiers, driven by that flight to quality.
So the top tier is doing well.
The top tier is definitely recovering. Downtown Class A, trophy assets. They're benefiting hugely from companies pushing return-to-office mandates.
Any specific examples?
Look at Toronto's downtown Class A vacancy. It dropped 250 basis points just in Q3. That's the biggest quarterly drop since 2008.
2008. Wow. So companies are really scrambling for that prime space.
They absolutely are. But, flip side.
If you own an older Class B or C building?
Yeah, you're facing some serious challenges. Or potentially a strategic opportunity.
Like converting it.
Exactly. We're seeing quite a bit of that.
Yeah.
Ottawa's a good example. They took about 190,000 square feet of older office stock off the market, specifically for residential conversion. Tackling two problems at once, maybe?
Interesting. Okay, let's shift to industrial. What's happening there? Rebalancing.
Yeah, rebalancing is the right term. The national vacancy rate actually held steady at 5.4%, which sounds flat.
But that stability was actually hiding something else.
Right. It was powered by a really significant surge in positive net absorption, almost 2.9 million square feet nationally. The market is correcting, filling up space again.
And let me guess the GTA played a big role.
Oh, massively. The GTA alone absorbed 3.6 million square feet, more than the entire national positive figure.
So it basically was the rebound, just solidifies its position as that key North American logistics hub.
Without a doubt.
Okay, finally retail. You called it the resilient outlier. It's becoming en vogue.
It kind of is, yeah. It's benefiting mostly from a historic lack of new supply being built for years.
So availability is super tight.
Incredibly tight. Toronto's availability rate is sitting at just 1.6%. There's just not much space out there.
And the type of retail is changing too, right?
Absolutely. It's thriving because the focus has shifted. It's about necessity groceries, pharmacies, and experiences. Think dining, entertainment.
People still need to eat, still want to go out.
Exactly. Those categories, dining and entertainment, they account for over half of all the new store announcements we're seeing.
So pulling this all together,
Yeah.
What's the big takeaway for you, the listener?
I think it's that the era of just buying anything anywhere, that passive approach,
Hmm.
it's just over.
Right.
Success now demands getting really granular, looking at the specific asset, its quality, its location.
So prioritize things like necessity retail, top-tier Class A office, modern logistics facilities in the right hubs. Uh-huh. And maybe well-located multifamily where you see potential for value add. Despite the near-term softening, you just have to be relentlessly selective now.
But that selectivity, it still operates in a wider world. There are external risks.
For sure.
We mentioned the U.S. tariffs at the start. That ongoing trade issue, it feels like the single biggest question mark hanging over the whole Canadian market, doesn't it?
It really does. It's the major external risk. So here's the thought to leave you with. If those tariffs escalate, if they really start to bite into manufacturing, into logistics, how stable will even those high-performing GTA industrial assets feel heading into 2026? That direct impact is the big uncertainty you need to think about next.